What is going on, everyone, and welcome back to Explain the Charts. Today is October 14th, 2025, and we are doing a deep dive into one of the most talked about stocks on the planet, Tesla, symbol Tesla. There is a ton of conflicting news right now, creating a classic battle between bulls and bears. We're going to break down all the recent headlines and then jump into the charts to see what the price action is telling us. First, let's talk about the news, which has been driving significant volatility. On the bullish side, we've seen positive analyst actions recently. Melius Research initiated coverage with a buy rating and a lofty $520 price target, while Evercore ISI also raised their target to $300. This optimism is partly fueled by news that Tesla plans to ramp up production at its key Shanghai factory, signaling strong global demand. The long-term bull case remains centered on Tesla's perceived lead in AI, autonomous driving, and its growing energy business. However, the bearish arguments are just as compelling and have been weighing on the stock. Concerns are mounting over decelerating growth, with Q2 2025 results showing a year-over-year revenue decrease and a miss on earnings per share. The company's valuation is a major point of contention, with a trailing P/E ratio over 250, which many analysts describe as being priced for perfection. Fierce competition, particularly from BYD in China, is putting pressure on Tesla's market share and margins. Furthermore, the recent launch of cheaper, stripped-down Model Y and Model 3 variants has received a lukewarm reception from investors. Many fear these new models won't be enough to stimulate demand, especially after the expiration of the $7,500 federal EV tax credit at the end of September. On top of all this, the broader market is grappling with macroeconomic headwinds, including persistent U.S.-China trade tensions that have caused wild swings in the market. So we have a classic standoff, a bullish long-term story versus very real bearish short-term fundamental and competitive pressures. Now, let's see how this narrative is reflected in the charts. Looking at the daily chart for the past year and a half, we can see the bigger picture. The stock had a phenomenal run from a low around $170 in June 2024 all the way to a peak of about $488 in mid-December 2024. Following that peak, we saw a significant correction down to the $220 level in late February of this year. The price then entered a prolonged period of consolidation for several months. Another major uptrend began in late June 2025, taking the stock right back up to test the previous highs. Just recently, on October 2nd, the stock hit a high of $470.75, just shy of that December peak, before being aggressively sold off. This recent peak and reversal align perfectly with the news of record Q3 deliveries, which the market interpreted as a sell-the-news event, fearing future demand would drop without the tax credits. From that $470 high, we've seen a sharp decline over the last 2 weeks. This chart gives us our key long-term levels. Major resistance is clearly defined at the recent $470 peak and the all-time high of $488. To the downside, the first major support area to watch is the low from last week around the $411 to $413 zone. Below that, we have the psychologically important $400 level. A more significant, structural support area sits down in the $370 to $380 range, which was a consolidation zone back in September and December of last year. Let's zoom in on the daily chart to the action since the beginning of September to get a better look at this recent reversal. Here you can see the powerful rally through September, which was driven by hype for the Q3 delivery numbers and positive analyst commentary. The reversal on October 2nd was violent, with a massive red candle erasing a significant portion of the prior gains in a single day. The sell-off continued for over a week, culminating in the low of $413.49 on October 10th. That low coincided with renewed fears of a trade war after new tariff threats were announced. However, yesterday, October 13th, we saw a very strong bounce. The stock gapped up and closed near the highs of the day at $435.90. This move was a direct reaction to news of easing trade tensions and the bullish analyst upgrade we mentioned earlier. This highlights just how sensitive Tesla is to macroeconomic news right now. Now, to get an even closer look at this bounce, let's switch over to the 15-minute chart, focusing on the price action since the low on October 10th. Here we can see the capitulation on Friday, October 10th, where the price plunged and eventually bottomed out around that crucial $413 level. Then, on Monday the 13th, you can see the significant gap up at the market open, with the price jumping to around $423. The stock then rallied strongly for the first couple of hours of the session. After hitting the day's high around $436, the price entered a consolidation phase for the rest of the day, holding its gains well. This price action sets up some very clear short-term levels to watch. The top of the opening gap, around $423, now becomes a key intraday support level. The high from yesterday, around $436 to $437, is the immediate resistance that bulls need to overcome to prove this bounce has legs. So, let's tie this all together with a summary and some potential scenarios. Tesla is currently at a critical inflection point, caught between a compelling long-term growth story and significant short-term fundamental headwinds. The upcoming earnings report next week will be absolutely pivotal for the next major move. Let's recap the key price levels to watch. Immediate resistance is at the $437 high, followed by the $450 to $460 zone, and then the major peak at $470. The ultimate resistance remains the all-time high around $488. On the support side, we have the gap fill level around $423. Below that, the most critical support is the recent low between $411 and $413. If that level breaks, we will likely test the $400 psychological level, with the next major support zone at $370 to $380. Now for some unbiased scenarios. A bullish scenario would involve the price holding above the $423 support and breaking cleanly through the $437 resistance. This would suggest the recent bounce has momentum, targeting the $450 to $460 area next. This outcome would be reinforced by continued positive market sentiment or a stellar earnings report. I would place the short-term likelihood of this at around 40%, as the stock faces considerable overhead resistance. Conversely, a bearish scenario would see the price fail to hold support and break below the critical $411 low. This would signal a continuation of the downtrend that started on October 2nd. This would likely target $400 and potentially the $370 to $380 support zone. A poor earnings report or renewed trade war fears could easily trigger this move. Given the recent sharp sell-off and fundamental worries, I'd put the likelihood of this scenario at around 60% in the immediate short term. The most important thing to watch is next week's earnings call. Pay close attention to guidance on profit margins and vehicle demand in a post-tax credit world. Any concrete updates on the FSD or Cybercab timelines will also be major market movers. Please remember, this is not financial advice and is for informational purposes only. Always conduct your own thorough research and analysis before making any investment decisions. Trading stocks, especially a volatile one like Tesla, involves significant risk. Thanks for watching Explain the Charts, and we'll see you in the next one.